All right, so today I wanted to make a video on the news that we've had it confirmed that rates are going to go down. Powell confirmed it at Jackson Hole this past week. But first things first, if you get value out of this video, please like, comment, subscribe. I really appreciate that. So getting right into it, what am I doing now that we have the news that rates are going down? And the gist of it is nothing significantly different. If you are just reacting to rates going down now and you're changing your investment strategy, you've almost certainly missed the boat, because when you look at the markets, they're forward looking, and we have 3 to 4 rate cuts that are already priced in. So this is something that if you're just going to change your strategy now, I would probably recommend against that, because the vast majority of it has already been priced in. So that's the first thing that I would lead off here. And we know that because REITs have done very well recently. Small caps have outperformed, and that's something that I've been bringing up recently as well, that when you look at lower rates, that typically benefits, it's going to benefit your REITs and companies that rely on borrowing to get by, but it's also going to benefit the small caps and the mid caps, especially the small caps, because those companies are disproportionately more likely to need to borrow money to grow. And that's something that if rates are lower, well, of course, that's going to make it easier for them. That's going to make it more profitable for them to operate. So that's kind of the gist of it, in that if you're looking at a specific area of the market, I don't think there's any REITs that I can think of that are actually a good buy right now. I was talking about Vici for a while, and they're up quite significantly over the last month or two. I remember seeing them at like 27, 28 and buying a decent amount. I wish I would have bought more, but again, what can you do? That's just one off the top of my head. But if I want to get into my specific strategy, it does not change at all. And whether the Fed is raising rates or lowering rates, it shouldn't change your fundamental investing strategy anything significant, because the best strategy, in my opinion, is you simply buy good companies at a good price. Whether rates are 1% or 10%, that shouldn't change that much. Now, what is a good company when rates are at 1% or 10%? That will change a little bit, but that's something that you constantly have to be vigilant to keep an eye on. So I'm going to go through my companies that I'm currently buying right now. And again, something you'll notice here is that there's no specific trend here. It's pretty much exactly the same as what it's been for the last while. So the first one is Masco. I've talked about this one before. I really like them. I'm not going to go into super big details in this because it'll be an hour-long video. Long story short, good company, good historical track record, good profitability. They're growing well. Every single one of these companies is below or basically at their historical valuations. There's a lot of other companies that I like, that I hold or want to hold, that they're just too expensive. And with the markets basically being at all-time highs again, the majority of the market is overvalued. So you really need to be vigilant right now to find value. The next one is PLAB. This is, again, speaking of small caps, this is a small cap semiconductor name. They perform very well. I think that they're a solid company. They're also significantly below their historical valuations. So that is something that I really like here. Although growth has slowed for this one, I still think they'll be okay. BAM. This is one that I think is debatably a little overvalued where it's at right now, but they're a spin-off of BN, so it's kind of hard to value them because they've only really been around for about a year or so. But they do pay a very good dividend. They're growing it very nicely. The business is rock solid. The real question is it's probably a tiny bit overvalued where it's at right now, but I don't think it's egregious, which is why I'm still slowly buying it. Skyworks, another one that I've talked a lot about before. Very solid company. I'm close to getting a full position in this company. I think that it's probably a little bit undervalued where it's at right now. I think fair value is probably like 115, 120. Let's see what analysts think there. 117 is the average. So right around what I'm thinking. CNQ, this is another one that I've talked about before. This is This is probably the best Canadian oil and gas name in my opinion. You could debate that some of the smaller cap ones might outgrow it, but with small cap oil companies, it almost always comes with greater risk. And I think that there's already a decent amount of risk baked into oil companies in general. So this one, again, very good historical track record. I mean, they've grown their dividend very, very significantly. They're at 4.26% right now. The payout ratio is just a tad over 50%. And they not only did they not cut their dividend in 2020, they actually kept growing it. So a company that's that stable and that well established, that's what I really like to see. So that's why I like them. QLYS, this is one I've talked a lot about before as well. This one I think is undervalued where it's at right now. This is a very good company in my opinion. It is a tech company, so I think that you could debate that it's definitely more risky than the market. But I think that the risk reward is definitely worth it here. I mean, a price of free cash flow of 17.7, a PE of 26. I think that it's worth probably a price of free cash flow of 20, low 20s probably. So I think that it's a buy up to 140 roughly. I mean, the average analyst is valuing it at 166, but again, the low is 115, the high is 231, so that's quite the spread, and you'll notice that with a lot of these kind of companies. But I think it's a buy where it's at right now. SMLR, this is one I've never talked about before, but again, I think they're a solid company, and not only that, they have taken the MicroStrategy route. They have exposure to Bitcoin, so that number one, I think they're a solid company. Number two, I think the exposure to Bitcoin is going to help them, so that's why I like them. ALLE, this is one I've made a video about in the past before. Another solid company in a good industry. Not a company that's going to rock your socks or anything like that, but very solid nonetheless. ODFL, this is another one that I really like. This one typically trades at a premium, but I think that it's worth it because this company is absolutely, this is if I were to only own 10 companies, I would find it hard to not include this one. So I really do like ODFL. Very solid company in an industry that's growing, and I think they're one of the best, if not the best name in the industry. The next one is GGG. This is Graco. Another very solid company. Debatably expensive where it's at right now, but again, I think it's in a good industry. It's a good company, very good track record. That's why I like it. EOG, this is one of the better oil and gas names, if not the best oil and gas name in my opinion. They've always done well. Again, this is another example of a company that never cut its dividend back in 2020. In fact, they kept growing it. I really like this company. They're buying back shares. The profitability is really good. This is one of the best, if not the best, oil and gas name in my opinion. Obviously, everything my opinion. Valero, another solid oil and gas name. I don't think they're quite as good, but I do still like the fact that they're consistently growing their dividend. They're consistently buying back shares. They're not growing it nearly as fast, but I mean, when you look at this company, they've outperformed the S&P over the last decade, and vast majority of oil and gas companies have not done that. So that's another thing that I like there. Watts Water Technologies. This company I really like. This is an A-level company. Really like them. They've always done good. They've continued to do good. They're probably about fair value where they're at right now. If I look at their historical valuation, they're actually a decent amount below that, but that's debatably expensive where it's at right now. I think they're roughly fair value where they're at right now. So anything below 190, I think it's a buy. Anything above 200, I definitely would not be buying. So that's what I think of them. TAD, this is another one I've never talked about before. A smaller cap name, this is kind of a high risk, high reward name. I mean, they're only $158 million. So this is one of those high risk, high reward names that I do have a very, very small position because of that. AOS Smith, this is another one I've talked about before. I really like this company. Not, again, another company that's going to blow your socks off. It's not going to be a 10-bagger by any means, but I think it's a solid company nonetheless. Applied Materials. This one is bordering on overvalued where it's at right now. If we get into its valuation here, it is above its historical valuations, but a price of free cash flow of 25, PE of 23, I don't think that's egregious for a company that's growing this well, that is this good. So I think that if you look, I mean, what do analysts have the average price target being 253, and the low is actually basically right where it's at right now. So I think in the past I have stopped buying this one right around 210, maybe 220. So I think it's probably about fair value where it's at right now, maybe a tad expensive. So this is, if you don't have it, it's probably a watch list candidate, not necessarily a buy where it's at right now. Accenture, this is one I really like. This is another one of those areas that I think is just really good. You're not going to get crazy growth, but I think it's just one of those areas that you want exposure to. The next one is NDSN. This is Nordson. This is one I've talked about before. Another very solid company in the machinery sector. And if you look at this company, they've always done well. So that's another common theme here. ITT, another example of that. Solid company. They're growing well. They've always grown well. They're growing their dividend well. And this is pretty much the common theme you'll see here. Almost every single one of the companies on this list is a dividend growth stock. And those are just the kind of companies I like. I mean, I have QLYS, which doesn't pay a dividend. SMLR doesn't. So there is some exceptions to that rule, but probably 80 to 90% of the stocks I own, they're dividend growth stocks. And I just love those companies because my plan is long-term holds. And the best long-term holds are companies that grow well consistently over time and deliver good returns to their shareholders. And a company that can consistently grow a dividend over 10, 20, 30 years, that's almost certainly going to be a well-run company. Now, again, if it's like a Altria or something like that's a little bit different. But those are companies that are good, that used to be good. I'm talking about companies that are still in those early to mid stages of growth. I don't like the Altrias, the AT&Ts of the world for obvious reasons. I've gone into it a lot because those companies, the growth just isn't in there. I do still want growth, but I want that combined with the share buybacks, the consistent earnings growth, the consistent cash flow growth, the consistent share buybacks. That's another thing you'll see. Most of these companies are companies that are consistently buying back shares as well. The next one is WRB. This is one I talked about very recently. One of the better insurance companies out there. Very consistent growth, which I like. Caterpillar. This is one of those companies that, you know, with the amount of population growth that we see in the West and the amount of renovations and cities having to expand, it's a company like this is going to do well. They are the biggest name, if not the biggest name in that industry. The next one is Owens Corning. This is another one I'm not sure. I believe I talked about it recently. I'm not sure off the top of my head, but I really like this company. Another company that's done very well. I mean, 9% free cash flow yield. That's crazy good for a company like this. LECO, another one in the electrical equipment industry. That's an industry that I really like. And I think it's going to do really good. AIT, this is one I've talked about before. Again, another area that I really like, an industry that I like. This is one of the better companies in that industry. American Express, this is another one that I've talked about before that I really like. And American Express is one of those names that honestly, there's not a lot of names that I think are must-owns. And I think American Express falls into that category because they have a very good moat. They're in an industry that they're very profitable. They have a very good track record. There's almost nothing that there isn't to like in this company. And I mean, you look at them, 13% free cash flow yield. That's crazy good. The next one that I'm not sure if I've talked about before, but this is My Lai Mercado Libre. This is kind of like the Amazon of South and Central America. That's one way of describing it. And the growth of this company is just absolutely phenomenal. The fact that they're based in South America, those are kind of unstable economies, so that there definitely is added risk that comes with this company. But I think the risk reward is worth it, so that's why I'm currently buying. And the last one on the list, one that I've talked about recently as well, is Fix Comfort Systems. This one just actually hit a 52-week high, but I don't think they're necessarily egregiously overvalued where they're at right now. They are above their historical valuations by quite a bit, But a 19 price to free cash flow, a 28 PE, probably a tiny bit expensive. I'm not saying you want to dive in head first right here, but I don't think they're necessarily egregiously overvalued. If you wanted to get in my opinion, I'd probably wait for like a 5-10% pullback. That's just what I'm thinking. So anyway, that is my strategy going forward. Like I mentioned earlier, the gist of it is that nothing significantly should change. You're always wanting to look for value. If I find a company that I like that is value, I don't care where rates are at. If it's a good value, it's a good value. And again, where a good value is for some companies will vary depending on where rates are at, but that's something you're already taking into account anyway. So nothing significant should change. So anyway, that is my opinion. Like I mentioned earlier, if you got value, please like, comment, subscribe, and stay tuned for more.